We're going to begin the second session. Discussion of the second paper. And so without further ado, let me ask Mike McKee of Bloomberg Television, Radio, and you'll find soon a theme here, but Mike is also a certified member of the August fishing group. And the fix is really in because John Silvia is my fishing partner. And so, and if he doesn't do well in the next hour, I have a story or two to tell you about. Mike, your panel.
I have a series of stories available for anyone who needs them in the future.
And I'm not going to talk about what I know about both of them. Well, it's somewhat appropriate. We're meeting here today at the Banque de France, given the subtext of many of the presentations here today is j'accuse. In many cases, central banks around the world have taken extraordinary measures in the pursuit of holding the economic crisis and world depression at bay. They are using techniques never employed in the pursuit of monetary policy, only discussed. If you go back to 2003 in a famous speech, Ben Bernanke outlined a long series of steps policy authorities could use to stave off deflation, culminating in Milton Friedman's famous last option of dropping money from helicopters. Though only paraphrase, of course, that suggestion earned Bernanke the nickname Helicopter Ben. And if you go back and look at that speech, the Fed has done everything that he outlined in that speech except for dropping money from helicopters. If he wishes to do so, I'll give him my address and go stand outside with a basket. More recently, we've seen the European Central Bank essentially triple the size of its balance sheet with just 2 lending operations. It is an extraordinary time. It has become, in the words of one analyst, a QE world. But economics is also the study of unintended consequences, and that law seems to always hold. In taking these extraordinary actions, have central banks caused other problems that will bedevil global economies in the years to come? It is a question American politicians, as we all know, are asking with increasing frequency. Olivier Coibion, Yuri Gordichenko, and John Silvia have looked at one of the possible knock-on effects of this extraordinary monetary policy, a widening of income inequality. The rich get richer, the poor get poorer. Are central banks to blame? Well, they find there is perhaps a case to be made. Olivier Coibion is the assistant professor of economics at the College of William and Mary and a GIC visiting scholar. He's also a faculty research fellow at the National Bureau of Economic Research. He's worked at the University of California, Berkeley, received his master's and his doctorate in economics from the University of Michigan. John Silvia is managing director and chief economist at Wells Fargo, which is now the world's largest bank by market cap. And he is a fellow, as you've recently just learned, of the GIC Global Society of Fellows. He's been with Wells since 2002. Prior to that, John was the chief economist at the Joint Economic Committee of Congress in Washington and chief economist to the U.S. Senate Banking Committee. He received his bachelor's and doctorate from Northeastern University, and his master's from Brown University, which I mentioned because my assistant back in New York is a proud graduate of Brown University, so this is for you, Allie. John's recently written a book, Dynamic Economic Decision Making, published by Wiley. He's a member of the Blue Chip panel of economic forecasters and serves as an advisor to the Federal Reserve Bank of Philadelphia. Our discussant today is Pierre Jaillet, Director General for Economics and International Relations at the Banque de France. He's been in that position since April of 2008. He's served as an advisor to the IMF, the senior economist at the European Commission, and an economist at the Ministry of Economy and Finance here in France. Monsieur Jaillet is a graduate of the Universities of Paris and Grenoble. Ali, I turn it over to you. Vous accusez?
So thank you, Mike, for the introduction. Thanks to the GIC for giving us the opportunity to present here today. Merci à la Banque de France. So in January, I attended the annual meetings for economists that were held in Chicago, and something very exciting happened. We were occupied. So the Occupy Wall Street movement showed up for the annual meetings of economists, which was really exciting. We were pretty kind of flattered that people would take the time to come and protest us, made us feel important. Granted, it was a pretty small contingent that showed up, and most economists didn't even realize that we were occupied, but still, it was kind of neat. And so one of the interesting things about the Occupy movements is these big signs that they have, right? And so most of them have to do with, we are the 99%, and, these reveal concerns about income inequality in the general population. But they also have a lot of signs that attribute causes for the rising inequality. So most of them have to do with the financial services sector, the big banks, the bailouts of the banks, and so on. But you'll also see a surprising amount of signs, that say end the Fed, or that'll blame the Federal Reserve for income inequality. And so for mainstream macroeconomists, this is pretty surprising because this is not a story that we tell about where the rising income inequality comes from. So let me show you a picture here, which is taken from work by Emmanuel Saez and Piketty, which shows the top 10% income share. So the top, it's a measure of rising income inequality in the U.S., and you can see how it's sort of exploded since the very early 1980s. Now, the standard explanations that economists would tell would have to do with things like skill-biased technological change. So this would be technological change which favors skilled labor, and so is increasing the demand for skilled labor relative to unskilled labor, and so is opening up a wage gap between the two. We tell stories about globalization driving inequality. And then some people emphasize more institutional factors, changes in unionization, the growth of the financial services sector. What you won't see is monetary policy being held responsible for any meaningful changes in income or consumption inequality. In principle, there's a number of channels through which monetary policy can affect the income distribution, the consumption distribution. So let me run through a few of these. So one channel would be if changes in monetary policy affect the labor incomes of individuals differently. Right? So if you think of the interest rate as the cost of capital, then to the extent that some forms of labor are going to be more complementary or bigger substitutes with capital, then a change in the price of capital will affect different forms of labor demand differently. You can tell stories about when you change monetary policy, different industries will be affected differently because they're more or less sensitive to changes in interest rates. So think of the demand for cars being more sensitive to monetary policy than the demand for haircuts. And so to the extent that different industries pay different wages, that can affect wage inequality. You can tell stories about even within a firm, if hiring and firing decisions are based on seniority, for example, then when you have changes in monetary policy to the extent that they affect demand for these firms, then hiring or firing decisions will disproportionately affect, say, the less experienced, who are also tend to have the lowest salaries in the firm, and so even that'll give you another channel through which monetary policy can affect the income distribution. Another set of channels could go through composition effects. So if different individuals receive their income from different sources, right? So you can receive income from salary, you can receive it from your financial assets, you can receive it because you own a business, because you receive transfers, right? To the extent that different households have different shares of income, and to the extent that these different income sources may respond differently to policy changes, right? Then that'll give you another channel through which policy could affect the income distribution. You could tell a similar story about the consumption distribution. If different households spend more or less on durable goods versus non-durable goods, that'll give you a mechanism that'll affect consumption inequality as well. Finally, there's wealth effects that'll affect both consumption and labor supply. So we often tell a story where when the real interest rate changes, right, then this is going to affect borrowers and savers differently. So a policy change which, say, raises the real interest rate will tend to favor the savers, and so that will tend to generate an increase in consumption inequality. You can also tell a story that has to do with portfolio allocation. So even if different households have the same net worth, right, to the extent that you allocate your portfolio into different assets, those assets may be more or less sensitive to monetary policy changes, in which case a change in monetary policy will affect people's wealth differently and therefore affect their consumption differently. Okay, so in principle, there's a number of channels through which monetary policy can affect both the income and the consumption distribution. So what we want to do in this paper is try and assess the empirical importance of these channels. And do we actually see anything happening to the income and consumption distribution in the data when monetary policy changes? Okay, and then secondly, we'll try to ask a question about the economic significance. So has monetary policy actually done anything meaningful to these distributions in the U.S.? Now, the way we're going to do this is in a sequence of steps. So the first problem you run into when you want to think about how monetary policy affects different kinds of macroeconomic variables is you have to worry about causation. Right? So in our context, imagine, say oil prices go up for some reason. And as a result, you see an unexpected spike in inflation. Right? So the spike in inflation through the kind of wealth channels that I described would tend to naturally have effects on the consumption distribution, right? But you might also see the Federal Reserve raise interest rates in response to the higher inflation. So if you were to just look at, when does the Federal Reserve change policy and then what happens to the distribution afterwards, in this scenario, it would look like the contractionary monetary policy caused the consumption inequality to decline, whereas really there's no causal mechanism there. They're both being driven by the same shock, okay? So ideally, what we would want is kind of natural experiments where the central bank would change interest rates for reasons that are unrelated to economic conditions, and then we could just kind of trace the effect on macroeconomic variables. In principle, what we would want is someone like Mr. Plosser to use a random number generator to decide on monetary policy for a while. This would really help out monetary economists to kind of give us these experiments. Now, until they do that, we have to try and think more carefully about how can we tease out the effects of monetary policy changes on the economy in a way that's not going to be confounded by these other shocks. So the way we're going to do it in this paper is to follow a procedure that was suggested by Christy and David Romer from Berkeley. So the idea is you're going to take monetary policy changes over time, and you're going to try and control for those policy changes that they did in response to their expectations of economic conditions. So you're essentially controlling for their typical response to, say, expectations of higher inflation, higher output growth, and so on. Okay, and so what you're left with after you do this kind of purification, what we can call unusual policy responses. So policy responses that deviate from what they normally would have done given these economic conditions. And then you can try and use these unusual policy actions, kind of like a natural experiment, to figure out what happens to the economy afterwards. So the graph I'm showing you here is an extension of the original Romer and Romer exercise. And so these are the estimates of unusual monetary policy actions that we see. So in the very early 1980s, of course, this is the Volcker disinflation, this is the monetarist experiment. There's tremendous volatility in interest rates and in policy measures, so you can see the shocks are quite volatile, but you get a lot of positive innovations to monetary policy, so a lot of contractionary monetary policy actions being taken. You can see kind of a temporary period of higher interest rates than would normally have been implemented in the mid-90s. That's the preemptive strike against inflation. You can see the period of interest rates being held quite low in the early 2000s. That's the too low for too long period that John Taylor emphasizes. And so what we're going to do is we're going to take these measures of unusual monetary policy actions and use them to characterize how monetary policy affects inequality in the U.S. Now, to measure inequality, again, we run into data constraints. So the data we're going to use is a survey of households that's done every month by the Bureau of Labor Statistics. It's called the Survey of Consumer Expenditures. And the survey is designed mainly to track households' consumption, but they also ask household questions about their income. So we're going to use both sources. So we're going to focus on several different measures of inequality. The first is we're going to look at the labor earnings of households. Okay, so essentially the Bureau of Labor Statistics will ask these households, how much did you earn in the last 12 months from salary, okay, from your regular labor. And so that gives us a distribution of labor earnings. And then in addition, they ask them about other sources of income, like business income, financial income, and then all sorts of transfers like Social Security, unemployment benefits, which we'll group into an other category. So when you sum up across these things, you get total household income, which is the second measure that we're going to focus on as a form of income inequality. On the consumption side, we're going to do something similar. We'll have kind of a narrow measure of consumption, which is going to be consumption of non-durables, services, and some smaller durable items like TVs, furniture, and so on. And then we'll have a broader measure, which we'll refer to as total household expenditures, which is that household consumption, plus things like mortgage payments, rental payments on rent, auto purchases, tuition expenses, medical expenses, and so on. Okay, so let me show you what these inequality measures look like in this graph. So the top line, does my laser pointer work? Not really, you can't see it. Okay. So the top black line is the Gini coefficient for total income inequality that you get out of this survey. And so sure enough, you can see kind of this general increase over time. You can see a similar thing for the second line from the top, the dotted line, which is inequality in labor earnings. Now you notice these don't explode the way that first figure that I showed you did. And this is because the survey of households that we're using is too narrow to really include the 1%. Okay, so the inequality that we're going to be talking about here is really inequality within the 99% of the distribution of households. Okay, so this whole, all these results we're going to be talking about are really not about the 1% of the distribution, okay, but about inequality among the rest of the population. And then the two blue lines underneath are the paths of consumption and expenditure inequality in the U.S. Again, you can see small increases over time, smaller increases than what you see for income, which is one of the interesting features of this data, is the fact that you see much less pronounced increase in consumption inequality than what you see for income inequality. All right, so once we have these measures of inequality, we have measures of unusual monetary policy episodes. What we can do is look at the average behavior of inequality to monetary policy actions. So what I'm going to show you is we call impulse responses, which is going to be essentially the average path taken by income or consumption at some level of the distribution after one of these monetary policy episodes, these unusual monetary policy actions. Okay, so we're going to be looking at contractionary monetary policy shocks. So think of this as like an unexpected or unusual increase in the interest rate. Okay, and I'm going to show you the behavior of labor earnings across the distribution, consumption across the distribution after one of these actions. Right, so we'll start with what happens to earnings inequality. So the horizontal axis here is expressed in terms of quarters. Okay, that's the time horizon. And so each of the lines is showing the response of labor earnings at some level of the distribution after one of these contractionary monetary policy episodes, at different percentiles of the distribution. Okay, so the two lines at the top, the red ones, are the responsive earnings at the 90th percentile of the distribution, so on the high end, and the 75th percentile of the distribution. Right? What you can see is about 2 years after the monetary policy shock, right, they're pretty consistently higher. The blue lines are showing you the responses on average of labor earnings at the bottom end of the distribution. So the 10th percentile at the bottom, the 25th percentile right above it, right? You can see what's happening is those are falling after one of these contractionary monetary policy shocks. Right? So said one of the channels through which monetary policy can affect the distribution of income and consumption is through having heterogeneous effects on labor earnings. Right? This is what you see here. So contractionary monetary policy tends to lower labor earnings at the bottom of the distribution, raise them at the upper end of the distribution. And you'll notice that in the first 8 quarters, the first 2 years, the results are extremely noisy. And that has to do with the way that the data is constructed. We're not able to track specific households over time. And so in response to a shock, there's a lot of churning inside the distribution, which accounts for why we get a lot of this noise in the short-run responses. Now, turning to kind of the narrow measure of consumption, right? So I'm going to show you exactly the same thing. So this is the behavior of households' consumption in response to one of these contractionary monetary policy shocks along different parts of the distribution. All right, and what's striking is for each percentile, right, the results are pretty much identical in the long run to what you see happening to the earnings distribution. So those in the 10th percentile or in the 90th percentile at the top are going to see approximately the same increase in consumption as their increase in their labor earnings, and the same thing at the bottom end of the distribution. And here you'll notice the results are much cleaner even in the short run, and the reason for this is this survey was constructed mainly to measure consumption expenditure, so we have much better data for consumption where we can actually track specific households as opposed to just the percentiles, and so we get much cleaner results with consumption than with respect to income. But the most important thing is the long-run effects are very much in the same ballpark. Now, the third panel is showing what happens to total income along different parts of the distribution. So the main thing to get from this is if you look at the red lines, the 90th percentile, the 75th percentile, even the 50th percentile, those line up pretty much with what we get for the earnings inequality. Okay, so the response of total income tracks the response of salary income very closely. If you look at what happens to the lower end of the distribution, the 10th percentile and the 20th percentile, you'll notice now they're quite a bit higher relative to what happened to the others. And the reason for this turns out to have to do with the second channel that we suggested, which was the composition of income sources. So I'm going to show you a breakdown of household income, the sources of household income for different parts of the income distribution. Okay, we did this for the 80s, the 90s, the 2000s. Turns out it's basically the same across decades. So we'll focus just on the 2000s for now. Okay, so we break the households into 5 quintiles, right? So groups of 20%. The 5th quintile is the highest quintile of the distribution. The first is the lowest quintile. Okay, so what I want you to notice first is if you look at the first column, the numbers in red, this is showing you the share of total income that comes from labor income for households in the distribution. So if you look at the 4th, the 5th quintile, right, you'll see numbers that are around 80%. So for households in the upper end of the income distribution, right, most of their income is coming from labor earnings. And that's true also in the third quintile. But then once you go down the income distribution to the 2nd quintile or the bottom quintile, that number drops off sharply. And what happens is those households are getting a lot more of their income from that 4th category, the other category, right? And those are essentially government transfers, pension systems, Social Security. And so in the bottom of the income distribution, a much larger share of income is coming from these compensating sources these transfers, and because these transfers respond much less to these monetary policy actions, the effect on total income at the lower end of the distribution is significantly dampened relative to what's happening to labor earnings. Okay, so you can think of it somewhat loosely as the transfers from the government are helping to mitigate the effects of economic changes on the bottom end of the distribution. And finally, we're going to show the response of expenditures across households in response to one of these contractionary monetary policy actions. You're going to see the same kind of pattern, right? Again, the red lines are at the top, the blue lines are at the bottom, which says lower income households are going to be reducing their total expenditures, while higher income households are going to be raising their expenditures. Now, what's striking in this case is not what's happening at the bottom end of the distribution, but rather what's happening at the very high end. So specifically, if you look at that red line at the very top, it's rising by a lot more than what's happening to either the earnings, the labor earnings, or total income for these households in this top end of the distribution. So there's a puzzle here about why are these households in the upper end of the expenditure distribution increasing their expenditures by so much. All right, so one way to try to explain this would be, again, to look at the composition. Perhaps the households in this part of the distribution just devote more resources to expenditures which are interest sensitive and which respond by more. So we did the same thing as we did for the income distribution, which is we took the different quintiles of the distribution, asked, are there big differences in terms of what these households purchase? Okay, is there a big composition effect? So it turns out, there's some differences. So as you go up the distribution, you'll find households spend more on durable items and interest-sensitive expenditures. You spend more on mortgage payments as your share of your expenditures. You spend more money on cars. You spend more on durable goods like iPads and so on. But there's no dramatic change, as you're moving up the distribution the way there was when you looked at income. Okay, and so the fact that there's no big distinction between what the third, the fourth, or the fifth quintiles are doing in terms of their expenditures means we're not going to be able to explain that disproportionate increase in expenditures at the high end of the distribution through a composition effect. So an alternative is to try and see if we can identify the third channel that we suggested, right, which is these wealth or redistributive effects of monetary policy actions. So what we wanted to do, ideally, was identify who are the savers in our data set, who are the borrowers, and see whether we see the monetary policy action having a big wealth effect that's different across these two sets of households. Now, it turns out in this data set we don't have any good measures of wealth, so we can't do this decomposition very precisely. But what we can do is we can appeal to other research which has looked at other data sets that has good information on wealth. And that research has identified certain household characteristics that are associated with being high wealth versus being low wealth. So to use their language, we're going to identify high net worth households as older households who own their house, so they're not making any mortgage payments, and they receive positive amounts of financial income. And then we're going to identify low net worth households as younger households who are making mortgage payments, so they have this, they own a house, they have a lot of debt associated with the house, and they don't receive any financial income. Okay? And then we'll look also what's happening to the rest of the distribution. And the question is, do we see a big difference in the expenditure responses of these households? Right? And we can look at, is there a big difference in their income versus what's happening to their consumption? So the two panels at the top now are going to show the responses of total income on the left and labor earnings on the right, specifically for these different groups that we've identified. So the solid black line is what's happening to the low net worth households. The red line is what's happening to all the other households. And the blue line are the high net worth households. All right, so the main takeaway message from this is, if you look at what happens to total income, you don't see any big differences in total income across these households. Okay, so it's not like the high net worth households here are going to be collecting a lot more income after these shocks than anyone else. All right? But now if I show you that what happens to their consumption and their expenditures, what you're going to see is significantly higher consumption and household expenditures on the part of these households that are high net worth relative to everyone else. Right? So the combination of no differential income response, but much higher consumption and expenditures is consistent with a wealth redistribution effect, okay, which could potentially account for why we see this big increase in expenditures on the high end. Okay, which suggests that you can see evidence of each of those channels that we talked about early on in the response of households' income and expenditures in response to policy actions. Now, the other thing we can do is then we can ask, rather than just looking at the average response to an episode in which you have, say, contractionary monetary policy in the data, what you can do is you can ask, well, what if we accumulate all the effects of these unusual monetary policy actions and assess whether they've actually had any meaningful effect on the behavior of income and consumption inequality in the U.S.? Okay, so what I'm going to show you now are a set of figures that try and quantify whether these unusual monetary policy actions, what we call shocks, have done much of anything to these inequality and consumption inequality in the U.S. So here are the paths for income and earnings inequality in the U.S. Now we've subtracted the trend growth in these measures over the time period. So what we're seeing are the cyclical fluctuations in these measures. So the dotted blue lines are the actual paths of these inequality measures in the U.S. And the solid black lines are the estimated contribution of unusual monetary policy actions to these inequality time series. So the first thing to notice is, it's not like monetary policy actions here are accounting for all that much of what's happening to income and earnings inequality. You can see some contributions if you look at kind of the gradual decline in income and earnings inequality from the mid-90s to the mid-2000s relative to trend. That appears to be consistent with some of these monetary policy actions that we saw. Though again, for example, there's a big spike in the late 90s in total income inequality, which is associated with the stock price increase during that time period, right? That has nothing to do with monetary policy. But you can see some evidence of monetary policy actions having an effect on the income inequality distribution. So in this case, the effect would be mostly saying that monetary policy actions tended to lower income inequality during this time period. We could do the same thing for consumption and expenditure inequality. So here, if you look at expenditure inequality on the bottom left panel, you see almost no contribution whatsoever of these unusual monetary policy actions to historical variation in expenditure inequality. And if you look at consumption inequality, you can see much more co-movement now between the black line and the blue line, which suggests that these monetary policy actions actually did have quite a bit of effect on the consumption inequality distribution. Though again, you'll notice there's no big trend effect. So it's not like these monetary policy actions have caused a big increase or a big decrease in consumption inequality, but it can account for quite a bit of the cyclical variation in the consumption inequality that we observe. Now, the measure of unusual monetary policy actions that we use in all our baseline results is come from this procedure suggested by David and Christy Romer, which is nice in a number of ways. But one thing it does is it combines all sorts of different sources of unusual monetary policy actions, right? So among the things that would show up as unusual monetary policy actions in our data set here would be, say, if there was political pressure on the central bank to either be more contractionary, expansionary for a while because, say, that there's some election coming up, right? That would show up as a shock. But if you had a change in, say, the chairman of the Federal Reserve, right? The new chairman disliked inflation more than the previous chairman, that would also show up in our measure as an unusual monetary policy action. Right, but in principle, some of these changes you would think of as being changes to the systematic response of the central bank to economic conditions, whereas others are very transitory effects. And in principle, changes in the systematic component of monetary policy and changes in very temporary deviations in monetary policy might have very different macroeconomic implications. So one thing we do in the paper then is we try and decompose these unusual monetary policy actions into what you might think of as changes in the systematic part of monetary policy versus changes in the transitory component of monetary policy. And one of the systematic components that we focus on are changes in the target level of inflation on the part of the central bank. So what I'm going to show you now is what happens if you look only at the historical changes in the target rate of inflation by the central bank, which essentially means looking at the Volcker disinflation, right? That's basically when there was a dramatic change, and since then there's been very little action. So if we look at the contribution of these big changes in the target level of inflation in the very early 1980s to income and earnings inequality, right? You can see those little blips, 1982, 1983, right? That's the estimated contribution of the Volcker disinflation to income inequality in our data. Right? This is very small. On the other hand, if you look at the implied contributions of the Volcker disinflation to expenditure inequality relative to trend and consumption inequality relative to trend, all of a sudden you get much bigger effects. Right? So how can you get these big effects on expenditures with very little effect on income? Well, again, the story would have to rely on redistributive effects of monetary policy actions across high net worth, low net worth households. And that then you can account for how monetary policy could have accounted for some of this increase in expenditure and consumption inequality that we saw in the very early 1980s. At the same time, there's two important caveats here that I would mention with respect to that last result. First, there's a strong case that can be made that the decreases in the target level of inflation in the very early 1980s from the Volcker disinflation helped stabilize macroeconomic fluctuations. And because macroeconomic fluctuations tend to disproportionately affect the labor earnings at the bottom end of the income distribution, okay, there would be another channel that's not incorporated in our empirics where the Volcker disinflation, essentially by playing a role in the great moderation, would have reduced both income and consumption inequality, which would not be captured in these figures. The other caveat is there's also a really big literature looking at the long-run relationship between the level of inflation and the level of inequality across countries. And what this literature has found to be quite robust is that higher inflation rates tend to be associated with higher levels of inequality. And so in that setting, reducing the level of inflation, such as through the target, changes in the target rate, would, in the long run, tend to be associated with lower levels of inequality. And the channel that people emphasize when looking at this cross-country literature is, again, a portfolio channel. It's the fact that lower-income households tend to hold a lot more cash. Higher-income households tend to put much more of their assets into more of their wealth into assets that are protected against inflation changes. And so in the long run, inflation is going to affect the lower end of the distribution disproportionately. And again, these long run effects would not be getting picked up by our empirical procedure here. I'm going to speed up. Okay. So let me just close by saying something about the zero bound on interest rates and its potential implications for inequality. So what our results suggest is when you have these unusual contractionary monetary policy actions, they're going to tend to increase income inequality, and they're going to tend to increase consumption inequality. Okay? Now, one way to think about the zero bound, which is meant to be illustrated in this graph, is that, as the Federal Reserve brought interest rates down to essentially zero and then got stuck there, right? Ideally, what they would have wanted to do is to lower them even further, right? So to move them down to something like the blue line, right, which would be the predicted value of interest rates had the Fed not been constrained by the zero bound. So one way to think about that gap between the two is that it's conceptually similar to having a sequence of contractionary monetary policy shocks, right? So that the Fed has been forced to push the interest rate higher than it would have liked. That's like an unusual period of contractionary monetary policy. And so if you interpret it that way, then what our results would suggest is that this period of unexpectedly tight monetary policy because of the zero bound would likely have contributed to higher income and consumption inequality because of the zero bound constraint on monetary policy. So because of the inability to provide as much expansionary policy as the Fed normally would have, we've probably seen a higher income and consumption inequality than we normally would have given economic conditions. Thank you.
Thank you, Olivier. I think John has a few things to add, and then we can hear from Pierre.
Sure. So how does Olivier and I come to this? Many of you picked up a couple of earlier papers that were written on this entire subject, and you're asking, why would Wells Fargo as a private institution or Mike Huebner as a private institution representative for Wells Fargo care about these income distribution per se? And I think in Olivier's first comments, we're talking about wealth effects, we're talking about consumer durable spending, et cetera. So in one of the papers that you have, and if you don't have a physical copy, maybe they ran out, I think Jill can get you an electronic copy, but for those of you that have this little paper here on relative intergenerational mobility, the challenge is, in terms of income distribution or economic mobility, the ability to move between different groups, there's a figure 3, and the first thing we ran into was the notable difference between the mean and median income. And immediately for Olivier and I, when you see this kind of graph, you immediately realize, as Olivier was talking, about the Gini coefficient, that the mean income in this group was much higher than the median sort of being the middle person in the income distribution, and yet the mean had really taken off relative to the median, and that suggested to Olivier and I that there was something of significance here that's worth looking at. And we went through many of the discussions, points that were raised earlier in terms of these other factors, education. And many of you know my writing. I've written a lot about economic education and the impact on income distribution and skills. But in figure 8 of this paper, for those of you, again, that have an opportunity to look at it later, it is fascinating. The income share, for example, from 1972 to 1982 for the bottom quintile. And remember, Olivier and I in this paper split a lot into quintiles. For the bottom quintile, the income share from 1972 to 1982 was around 7%. The income share from 1999 to 2009 was 4%. So you immediately could see that the bottom was getting a little bit less, but the top quintile in 72 to 82 had 38%, and in 1999 to 2009, the top quintile had 47.5%. So that was the motivation behind our paper, behind all the analysis and the detail. But in practical matter, the challenge for many of us in the private sector is that when we make a loan or we give credit to someone, we expect that over time there is some economic mobility up the scale, that over time the bottom quintiles move to the middle and the middle eventually moves to the top. And again, for many of us who are sons or grandparents of immigrants coming to America, that's almost the expectation. And what Olivia and I were focused in on is the perhaps impact monetary policy has on those income distribution, economic mobility arguments, trying to do it a little more statistically, a little more analytically than otherwise. But I wanted to make sure that you understand the motivation from our point of view, and again, why Mike Heavner gives us such support here at GIC. And that's it. Thank you.
All right, thank you, John. Now our discussant, Pierre.
I need the files to
I need to.
Yep.
Doesn't seem to be on here.
Yeah, it's not on there, if you think, yeah.
Doesn't look like it.
Does everyone have the physical copy? There is a physical copy for those of you that are interested. Sort of 2 little slides on a page kind of thing.
Let him get a copy.
Pierre, do you want me to read it for you? I can fill.
Do we have Jill around, our expert on?
Okay, sorry for that. Thanks to GIC to allow me to discuss this very interesting paper. No, it should be settled on the computer very soon. I was happy to learn that Olivier Coibion is one of the French US young academic that we try to get back in France, and especially in the Banque de France. Sometimes with success, sometimes without. And of course, we try to make our research more attractive, and maybe the weakening of the dollars might help. But it's not a wish, or neither a wish nor a forecast. Okay, so redistribution impact of monetary policy. This is clearly a domain not so much visited over the past decades. Monetary policy is generally viewed as economically, socially neutral, and that prominent view is consistent with the general consensus which has been adopted over the last decades to have independent agents in order to define and conduct monetary policy, and especially independent central banks with very well-defined mandate. So the contribution of Olivier and John and Yuri, who is absent, suggests that this common view may be somewhat challenged. And what is the paper about? The paper seeks to characterize the dynamic effect of monetary policy shocks on income and consumption inequality, and it focuses mainly on the United States. This is a very, thanks a lot. So we can, thanks. So the paper seeks to characterize the dynamic effect of monetary policy shocks on income and consumption inequality. This is a very thorough and innovative piece of analysis, mainly based off consumer expenditure survey data, combined with the smart empirical approach which relies mainly on Romer and Romer seminal work on monetary policy shocks. What are the main results? First, monetary policy shocks have large effects on inequality, either in terms of consumption, expenditure, income, or wages. And perhaps even more interestingly, the paper spots significant reverse distributional effects of monetary policy since the 1990s. So this is a must-read for first pass. It's clearly a path-breaking piece of research. Meanwhile, there are maybe some caveats. The first is the methodology entails risk of confusions between permanent or disinflation monetary policy shocks and transitory monetary policy shocks. And we know that this is particularly important to establish this when assessing the distributional impact of monetary policy shocks. Also, the paper is, I would say, almost silent on wealth distribution. Certainly, it's probably due to the poor quality of consumer expenditure wealth data on that. Although this is typically the first things to come in mind when we discuss inflation and its redistributive effect. So I will now highlight a complementary angle, not a substitute, but a complementary angle consistent with the Eurosystem prime mandate, which is, as you know, price stability. An important remark here is that ideally, central banks would like to be neutral in terms of redistribution in the process of keeping price stable. I made the point before. And I will stress successively 2 points. First, on the short run or the business cycle perspective, this raises questions about details on how mandate of CBs is implemented. And in the long run, this raises the question of appropriate target choice and consequently thereof. So the fact is, inflation has redistribution shock effect, affecting all agents and sectors depending upon the structure of their assets and liabilities. And a deeper understanding requires microdata, as perfectly emphasized by Coibion and Ali in the paper. Data on net position and portfolio composition seem particularly crucial. And this is a gigantic task, actually. And there are some very good pieces of literature that I would like to quote here, Dobke and Schneider for the US, May and Tarajima for Canada, and the Eurosystem Household Finance and Consumption Network for the Euro area, which is a network gathering all central banks of the Eurosystem. And the main results, given the portfolio composition, and we know, of course, that old rich households are net lenders, and poor middle-class people are net borrowers. This is, of course, a key point that we have to bear in mind. So 3 main results. The first is that inflations and transitory inflation shocks redistributes wealth from asset-rich old to middle-class young agents. Second result is that we have large wealth cross-border transfer from foreign sector to government if debt largely held by non-resident, which is, I would say, the case in most advanced countries, with the exception of Japan, of course. And we have exact macro and welfare effects depending on how fiscal side adjusts and secondly, how central banks read the price stability mandate. This is a very important point, and I would like maybe to enlarge a bit it here. Assuming that government adjusts passively, which means that they get a revenue neutral overall effect on public finance. the effects of an unexpected price shocks will depend on how monetary policy is conducted. If central banks have an inflation targeting strategy, we get a large distributional effects because the shock is not compensated. And it's not compensated because inflation targeting doesn't call for a change in monetary policy after a transitory shock. So this means that the price level shifts permanently. This means that the nominal assets are depleting permanently, and the rich are, I would say, affected permanently. If we have, and this is the second case, a price level targeting strategy, which, by the way, is not followed by any central banks, to my knowledge, in the world, price hike gradually is gradually compensated. This can, of course, severely and conversely affect poor people and preserve rich households. So taking stocks on this business cycle perspective, in the short run, CBs are not innocent bystanders, clearly. The nature of the mandate of central bank is crucial. However, the effect should not be exaggerated if central bank is successful, and if central banks are credible, surprise price hikes should have a low variance. It means that you put in the world, if the central banks do the job correctly, there is not much to expect from inflation shocks, and distributional effects will remain marginal. Still, Coibion analysis suggests that these inflation shocks might have had permanent effect on income quality. That leads me to my last and next point. Now, we have a look at the long-term perspective, and actually things and results won't be that different. There exists a long-run positive relation between inflation and various measures of inequality, and I would call here Albanese particularly, though best viewed as a correlation. 3 minutes, okay, I will respect that. It's a correlation rather than evidence of causality, and this relation must be investigated. And the basic theoretical apparatus is that inflation is a tax with distributional outcomes. But this traditional view is complemented, if not challenged, by a new view, which is that inflation is also a regressive tax on transactions. And we can highlight 3 main points here. The first is that composition of portfolio is biased towards a larger fraction of interest-bearing securities as people get richer and richer. Most transactions paid on credit by rich people are less subject to inflation tax, naturally. And as financial sophistication increases, there are greater opportunities for rich people to hedge against inflation. So taking stocks on this long-term perspective, I say in the long run, CBs are not more innocent bystanders as they are on the short run. Here too, nature of the mandate of CBs is very important. And there are possible redistributional issues as a key justification for targeting low, so positive, steady state inflation rate. And my conclusion, my general conclusion is, be it in the short or long run, CBs are not innocent bystanders. I think at this point I will converge perfectly with the authors of the paper we are discussing today. As the discussion suggests, this raises tricky and not easily answered questions. And the next step, to my mind, is the further investigation into the interplay between fiscal policy, monetary policy, and financial sophistication. I would say the monitoring of the development of financial innovation, which is very important. And by the way, this point is very high in the current policy agenda, specifically in the G20 on the G20 agenda, but not only. My final word is that your work, Olivier and John, is very path-breaking on a topic viewed as more and more important, and that will certainly be even more important if we consider the role and mandate of central banks in the future. Thank you.
Thank you all very much. Congratulate our panel for doing a very good job of sticking to the time allotted. However, we got started a little bit late, so we are going to not do questions with this panel and move on so we can get back onto schedule. But I did want to offer Olivier or John, one or the other, 2 minutes to respond if you have a response.
I'll take one if you take one. Okay, quick commentary on page 4 of the handout. 2 quick points. Inflation redistributes wealth from the asset-rich old to middle-class young agents. One of the great debates going on, I think, in the private sector of the financial market is all this financial repression argument. That in fact, inflation's maybe 2-3%, maybe 4%, and the savers get 0.5 to 1%. This comment has come up several times in questioning with Chairman Bernanke. And the second is that this challenge, Pierre, of a large wealth transfer from the foreign sector to the government if debt is largely held by non-residents. This is a growing concern in the United States, that so much of our debt is actually held abroad, and there's the question that if we start depreciating the dollar or raising inflation, the cost of that actually doesn't fall on the U.S., it falls on foreign investors, and that's a little bit of a tricky game in the private sector investment world. Thank you.
Olivier?
I'll just say thank you to Pierre for the excellent comments and wrap it up.
All right, let us thank all of our panelists, Olivier, Pierre, and John, and I'm sure they'll be available outside the room to answer any questions that you might have.
And we should also thank Mike McKee for moderating this panel. We have had 2 superb, thought-provoking panels this morning. The first one we heard about the zero bound. It's controversial. We'll discuss it for a long time. The second one, we saw a chart which showed what the interest rate might have been were it not constrained by the zero bound, and the argument about what real interest rates do. And then we saw some very thought-provoking information about income distribution in seminal work done by 3. One is not here. And I think Pierre summarized in an economy of time the cutting-edge thoughts that we can debate only quickly over the coffee break, because we're going to resume with Bill Miller very fast. Thank you very much, panel.